Okay, now the session is being recorded, except for it's gonna be boring for another 14-15 minutes. Final is not cumulative. Similar to midterm. What do you mean by similar to midterm? Hmm. 10 multiple choices, 5 problems, 1 short answer. Let me see. What did I do for final? No, there's no chapter 1 to 5 in final exam. The final exam is on chapter 6, 7, 9, and 10. Yes, the formula sheet. Let me make it available. Formula sheet. Yes. For Megan, yes, I will. I will provide it after the class. For Tanil, the final, did you say 10 multiple choice, 5 problems, 1 short answer? I'm still debating if I want to give you a short answer. I think it will be definitely about 10 multiple choice, 5 problems. Maybe just skip the short answer. I don't know how to make you guys say talk about a question and make it short. I mean, for the final, if I'm gonna ask you any deeper question, it probably demand a long answer, not a short answer. I do expect you to have all the analysis done. So I should see all the numbers, and the tables should be done. That allows you 1 more week to finish the paper. So you don't have to show me the paper, but you do need to show me the the analysis results. No problem. Okay, so how many of you have done? Let's see. Let me see if I can have a poll. So can you tell me how many questions you have done? So 2 of you just do 1 question? That's impossible. If you have done 5 or more, then pick 5. Come on, people need response. Okay. I need 5 more responses to see how everybody's doing. Oh well. Do we need to tell you before the presentation what company we're doing? Yes, everybody already told me. Please email me. Okay, so we probably need to spend some more time since most of the people are still around 2 or 3 questions. Let's extend it a little bit more, give you another 15 minutes, and then we go on to work through the questions together.
confused.
Let's do a second poll and see how's everybody doing. Come on, people, come on. Wow. Two questions. You guys really need to be strategic. I know the second question is kind of hard, but then you can skip that and jump on to the later ones that are a little bit easier. And where are the 6 more? 6 other people not talking to me. Oh, good. So 4 more. 4 more. Come on, people. Okay. Let's forget about the 2 who are not talking to me. Okay, so let me see if I can make it a little bigger.
Hello?
Hello? I can hear you.
I can hear you. Okay, we're good.
Good. Okay, so I would say for these questions, right, so we have, for each chapter I selected several questions. These questions are on the hard side, so don't get too frustrated if it involves a lot of steps. For chapter 6, it's mainly about the return, beta, and stuff. And then that is right. Oh, it jumps around. Okay, so that's number 3. Yeah, for chapter 7, it's mainly about calculating the stock price, discounted cash flow, discounted dividends, current yield and stuff. Dividend yield. And for chapter 9, it is all the cost of capitals. And chapter 10 is about, of course, how we use the cost of capital and use the NPV IRR models to look at the capital budgeting. So these are the chapters. These are the 4 chapters we're going to cover in the final. So let's look at, of course, I'm going to publish the final answer of all of these. So I'm going to pick some of them and go through them. So question 1, if you guys have question, feel free to raise your hand. Okay, so you can, did you find the raise hand? See? And once you raise your hand, I can see you're raising your hand. Okay, so then I will stop and then can answer some question, which is the main point of this session. Okay, so chapter 6, you've been scouring Wall Street Journal looking for a stock that are good values, and I've calculated expected return for 5 stocks, assuming the risk-free rate is 7%, market risk premium 2%. Which security will be the best investment? Okay, so Zoom, you must choose just one. So which one are you going to think is the best investment? The best investment should be really this one, right? So let's look at it between A and E. Okay, so whereas the, let's see, 7%, how do I say it? Okay, so 7% plus whatever beta times the 2% should be the expected return, right? So just do some quick mental math. 1.7 times 2, 1.7 as the beta times 2 is going to be 3.4 plus 7 is going to be, for the first one, the expected return in the market should be how much? According to the beta, it should be earning what? So 7 plus 1.7 times 2, which is 3.4, equal to 10.4, right? So expected return is below that. For this one, 0.5 times the 2% market premium is going to give you 8%. So now this one is actually having a expected return that is higher than this expected return is higher than the required rate of return. So this one is a good one. What about the third one? Okay, negative 0.67 times 2 plus 7 should be equal to how much? 7 minus 1.34, right, is equal to 5.66. Sorry. And again, this expected return is lower. Expected return of this company is lower than the market required return. So what market is requiring 5.66. This one can only give, oh dear, sorry. Oh, is there a way to recover that? I guess not. I hate that. Oh, there's no way. There's no way I can just erase a little bit. That's ridiculous. Okay, but anyway, so far the conclusion is that B is good. And for D, again, 0.87 times 2 plus 7 is equal to how much? 1.74, right? 74 plus 7 should be equal to 8.74. Then it's exactly equal to the expected return. And in the last case, 2.5 times 2 plus 7 is equal to 12%. And again, the expected return is falling short. So that's why we should really be selecting the second option right there, because that's the only one that exceeds the market required rate of return. Okay, any question? So far so good. Number 2, managing the account of a large investor. Holds the following stocks, and this is a portfolio. So required rate of return is 17%, risk-free rate. Risk-free rate is 7%, and return on market is 14%. So what is the stock D's estimated beta? So first of all, what is the first step we need to figure out is what is the portfolio beta. Okay, so portfolio beta is gonna be the from the portfolio required rate of return should be equal to the 7% risk-free rate plus 14% minus 7%. That's the required rate, the market risk premium times the beta of portfolio, right? So beta of portfolio. So if we solve for beta of portfolio, beta P should be equal to what? 17 minus 7 bracket divided by 7. Right, so should be equal to, let me open an Excel real quick. Mm-hmm. 1.428. Okay, so this is the portfolio beta, and then from the portfolio beta, we should be able to estimate the whole beta, the beta of D. So first thing first, if the whole portfolio beta is 1.428, immediately you should be able to observe that this portfolio beta is higher than any of these betas. Right, so immediately you know this question mark, that beta has to be higher than 1.428. Why? Because if the average is 1.428 and the other three, A, B, C, are falling below it, then the D is the only one that could potentially drag it up to 1.428. So immediately you weed out this one is too close. You're definitely going to try these. So if we have only 2 options left, the quickest way is not to solve for it, but to try it in there, right? So you can plug in one of them and say, for example, if I plug in 2.154 in there, and then quickly calculate it to see if it's 1.428. If it is, then that's it. If it's not, then D is the answer. So does that make sense? So alternatively, of course, we can solve for it. So if we're going to solve for it, then it's going to be 1.428 is equal to the portfolio beta, which is the weighted average of all the other betas. So it's going to be, let's look at what is the weight. So if we add all of these up, it's 2 million, 5 million, 3 million, 5 million, adds up to 15 million, right? So for each one of them, they have a ratio. So the first one is going to be 2 out of 15. It's 2 over 15. Second one is 5 over 15, or 1/3. Third one is 1/5. The fourth one is 1/3. Sorry. Right. So we take we take 8 times 2 divided by 15 plus 1.1 times, divided by 3 plus 1.4 divided by 5 plus 1 plus x divided by 1 divided by 3, sorry. Right? So solving for x, so if we solve for x should be equal to 3, so 1.428 times 3 minus 1.6 divided by 5 plus, minus 1.1 minus 1.4 times 3 divided by 5, right? Okay, so that should be equal to, let me use an Excel, equal to 1.428 times 3 minus 1.6 divided by 5 minus 1.1 minus 1.4 times 3 divided by 5 is 2.24. Okay, so it's equal to 2.024. So with the rounding error, the best shot should be this one, the D, right here. Okay, so questions. How did you get 2.2 divided by 15? This one? That's 2 million divided by 15 million. That's 2 million divided by 15 million. So 15 million is the total, right? So this is the total. Yeah. So that's how you do it to get a weight of each one. You're welcome. And moving on to number 3. Company X has a beta of 1.6, while company Y's beta is 0.7. The risk-free rate is 7%. Required rate of return on average stock is 12%. So what is the average stock? That's some market portfolio, right? Now the expected rate of inflation built into risk-free rate rises by 1 percentage point. The risk-free rate remains constant, required rate of return market rise to 14%, and the beta remains constant. After all of these changes have been reflected in the beta data, by how much will the required rate of return on the stock X exceeds that on stock Y? That's a complicated one. Okay, so basically, let's list everything that we know. So beta of X is equal to 1.6, right? And beta of Y is equal to 0.7. Okay. And risk-free rate, or KRF, as is equal to 7%. The market, notice that when we talk about an average stock is giving you 12%, that means the market is giving you 12%. Okay, so that's really how it works. I think somebody just happened to put some mark on it. What try to erase it. Let's see. Can I really do that? Okay. So it's back to working. Okay, so inflation increases by 1%, but the K remains constant, right? So the risk-free rate increases by 1%. The market risk-free, the market return rises to 14%. So before the inflation change, change, the return of X is equal to 7 plus what, 5% times 1.6, right? So that's a total of 15%. Yeah, that's right. So then for Y, the return is what, 7 plus 5% times 0.7. That's equal to 10.5%. Okay. Now, after the inflation change, the capital X should be equal to what? Now the risk-free rate is 8% because it increased by 1%, and the market becomes 14. So market risk premium is 14 minus 8, and times the same beta. The beta is not changed, and that's gonna give you how much? 6 times 1.6 is 9.6. 9.6 plus 8 is 17.6%. Okay. Then we have do the same thing for the Y. .7, that's equal to what? 6 times 7, 4.2 plus 8, that's 12.2%. Okay, so then the difference between them minus K of Y is equal to 7.6 minus 12.2 is equal to 5.4%. So by how much the X return exceeds the return of Y, that's 5.4. So answer is D. Okay. Any questions? Other than I'm going kind of slow. Okay. Number 4. Investor 5,000 invest in stock with an estimated beta of 12%, 1.2. Another 15K invest in stock company which she works. Okay, so she works in one and then invested in another stock. Risk-free rate is 6%, and the market risk premium is also 6%. Investor calculated that the required rate of return on her total 20,000 portfolios 15%. What's the beta of the company for which she works? Okay, so it's again kind of like a question 2. Right, so you know the whole the total required rate of return for the portfolio is 15%, so the portfolio beta, so so we have 15% is equal to the risk-free rate of 6% plus the market risk premium 6%. So be very careful between market risk premium or the market return. Okay, so sometimes the market risk premium is given, then you just multiply the market risk premium directly to the beta. Sometimes the market return is given, so that's a different story. So make sure you take market return minus the risk-free rate in order to get beta. In order to get market risk premium. Sorry. So solving for this beta of the portfolio, that gives us what? 9 divided by 6 is equal to how much? 1.5, right? So the total is 1.5. Total portfolio beta is 1.5%, and that should be equal to what? 1.2 times 5,000 divided by the total of 20,000 plus an x times 15,000 divided by 20,000. Okay, so how much is x? X is equal to, this is a 1/4, right? So it's 0.25. 1/4 0.3, 1.5 minus 0.3. Then divide by, kind of take 3/4, right? Times 4 divided by 3 is equal to 1.2, 1.2, 0.4, 1.6, right? How did you get 9? How did I get 9? It is 15 minus 6, right? So if we are solving for this one, we take 15 minus 6, that's 9, right? Okay, so any other question? So basically, you just need to solve, you need to put in the formula and solve for it. To save some time, let's move on. Number 5, investors forming a portfolio by investing 50 grand in stock A, which has a beta of 1.5, and 25 grand in stock B has a beta of 0.9. Return on the stock on the market is equal to 6%, and treasury bond has yield of 4%, so that is the risk-free rate. So what's the required rate of return on the investor's portfolio, right? So so A has a beta of 1.5, and B has a beta of 0.9. So the first thing we need to do is calculate the portfolio beta. The portfolio beta is equal to the weighted average of stock A beta and stock B beta. So that's going to give us 1.5 times the stock A weighting, which is 50 grand, divided by 50 plus 25 grand, right? So total 75 grand. Plus 0.9 times 25 grand divided by 75 grand. All right, so that should give us how much? So let's use Excel 1.5 times 5 divided by 7.5, right? 7.5 plus 0.9 times 0.9 divided by 3, basically. Divided by 3 is 1.3. Right, so then what's the required rate of return? Then it's just a way of plugging in the CAPM. So risk-free rate 4% plus 1.3 beta times the market risk premium. So return on the market is 6, and market risk premium is a return on market minus the risk-free rate 4. So that should give us 4 plus 1.3 times 2, 2.6, it should be 6.6. Right, so the correct answer is A. Okay, so this one correct answer is A. Any question? Okay. Excuse me. What Jasper currently managed this and is expecting to receive an additional this from new client, existing portfolio required rate of return, risk-free rate this, and what should be the average beta for new stock added to the portfolio. So that's pretty simple. Let me skip it here because for the sake of time, we cannot work through every single question. In number 7, what's the new beta portfolio? Also kind of similar to what we have done before. Okay, so let's move on to chapter 7. Chapter 7. So Gotsia has a current dividend of 3 per share and expect that dividend will grow at a rate of 25% a year for the next 3 years. That's a very high growth rate. Okay, so therefore, thereafter will grow a constant rate of 10% a year. The company's cost of equity capital is estimated to be 15%. So what is the current stock price of Gotsia? So in the first 3 years, we're going to have 1, 2, 3, right? So had a current dividend D0 of $3. And the first year is going to be 3 times 1 plus 25% growth, right? 1.25. That's going to give you what? 3.75. Okay, I should really use this. Second year is going to be 3.75 times 1 plus 25%. That's going to give you 4.6875. In the third year, we're going to have 4.6875 times, again, 1 plus 25%. That's going to give us how much? 5.8594. Okay, so basically, we're going to have 3 here. That's just paid. The next year, we're going to get paid 3.75. The year after, 4.6875. Year after, 5.8594. Okay, so now we also need to calculate after that, after this particular year, it is going to grow at 10% a year, like forever and ever. Right, so after that, at that time, the value, if we're looking at the whole story at that time, the terminal value should be equal to what? Should be equal to the dividend at that time. So D dividend of the 4th year, okay, oh sorry, dividend of the third year, right, B3, grow at the permanent long-term rate at 10%, 0.1, divide by the R, the required rate of return 15%, minus 0.1, right? So remember we had the price at 0 should be equal to D0 times 1 plus the growth rate divided by R minus the growth rate, right? So we have that, oh sorry, and this one should come out to be equal to 0. Oh sorry, B3 is 5.8594 times 1.1 divided by 0.05, which is equal to how much? 128.9. Okay, so on top at this time, remember this is equal to what? P3, right? So this P0 will be using D0. If here we're using D3, here we're using D3. So we are gonna get P3, right? So this P3 is basically the terminal value we're gonna get for the whole stock for the rest of the infinite future, right? So we have on top of this 5.894, we have this 128.9. Okay, so in total, if we combine everything, we're gonna have this discounted. If you put in the cash flow calculator, right? So cash flow calculator right here. I'm gonna put in cash flow, and the initial cash flow to be initial outlay to be 0. The first cash flow, let me clear it out. The first cash flow, we put in 3.75. Sorry, 3.75. Enter. Going down, repeat only for 1 year. Then the second cash flow, 4.6875. Enter, and then repeat only 1 time. Then the third time, the third cash flow is gonna be 128.9 plus the 5.8594. The third one is 128.9 plus 5.8594 equal to 263. I don't know. I think something is wrong here. Let's use Excel. 128.9 plus 5.8594. 134.7594. Right, enter that third cash flow, and that's it. So only 3 cash flows, and take a discount rate. What is the discount rate here? The cost of capital, cost of equity capital, right? So the discount rate here should be 15%. This one right there. Okay, so it should be press NPV. When it asks me for the I here, when it asks me for the I here, I don't know if you see it, I put in 15, right? Then enter, then go down and press compute. We should get NPV equal to 95.42, right? So 95.42, which is the closest one is here. The closest one is this one. Okay, so this is a very typical discounted dividend kind of question, and I hope you get it very well. Number 2, the company paid a dividend of 2, growth rate 4% for 1 year, 5% the next year, 6% following year. Then the growth rate expected to be a constant 7%, required rate of return 10% was the current price of the common stock. Same question as number 1, except for the first 3 years, each year is going to have a different growth rate, right? So basically, you are going to take today is going to be 2.00, right? And then the first year, second year, third year, right? The first year is going to be 2 times 1 plus 0.04, right, is equal to 1.04 times 2 equal to 2.08. And the second year is going to be 2.08 times grow by another year for the 5%. 0.05, sorry. Should be 1 plus 0.05. So that's 1.05 times 1.08. 1.05 times 1.05 times 2.08 should be equal to 2.184. 2.184, and then the third year should be 2.184 times 1 plus 0.06, right? So that multiplied by 1.06 is equal to 2.315. 2.315. Right, so then we're going to use the third year. So we're going to take these 2.08, this one 2.184, third year 2.315. Then we're going to take using this 2.315, that last D multiplied by the grow it at the long-term constant rate and 7%, 0.07, and divided by what's the required rate of return, 10%, right? 0.1 minus 0.07, sorry, wrong, is equal to, so 2.315 times 1.07 minus 0.03 is equal to 2. I don't think it's right. 2.315 times 1.07 divided by 0.03. 82.56. Now it should be right. So the terminal value should be the sum of 82.56 and the 2.315. So the terminal value should be equal to 82.56 plus 2.315 which is equal to, oh, I pressed the wrong buttons, 82.56 plus 2.315 is equal to 167.44. I don't think so. Why is my calculator giving me weird numbers? Just don't understand. 82.56 plus 2.315. How's that difficult? Just don't understand this one. 75. Okay, so then we plug in all those cash flows into the calculator. Okay, there might be some rounding error. I hope I'm getting everything correctly. Oh, I just don't trust my calculator anymore. This calculator is ridiculous. Let me just double check to make sure I'm telling you the correct number. So 2 equal to 2 times 1.04 times 1.05 times 1.06 is 2.31544. Okay, so that is equal to that times 1.07 divided by 0.03. 57. 569, so it's 82.57. This one is equal to this plus that is 84.884648. Oh dear. So let me, instead of coming here, we just, so it should be really 82.56979798 plus 2.315. Sorry about the rounding error, and that should give me 84.8848. Okay, so that should be the correct answers. Oh, is there a way that I can move these? Select. Oh, good. Oh, goody. Okay, I can change that. That's good. Oh, good. 98. Oh, wonderful. Okay, good. Now we're talking about it. Now we're talking. Let me just put this one. Can I delete it? Can I delete it? Is there a way to delete it? Bring it out of the picture. Okay, so once we know the terminal value, so we have the first cash flow. The first cash flow is this one. Oh, sorry. This cash flow, first one. This one is the second one, and the third one is this cash flow. And then we calculate the NPV, except for we don't give it an initial outlay. So that should give us the correct answer. And the correct answer is 67.47. So answer is D right here. Okay, any question? Suppose the company's current free cash flow is 100 million and is expected to grow at a constant rate of 5%. The company's overall cost of capital is 15%. What's the current value of operations? Right, so So the value of the operations should be equal to the value of operations should be equal to free cash flow 1, okay, divided by what, the K minus G, right? The cost of capital 15%. So that should give us 100 million, which is FCF 0. And FCF 1 should be 100 million times the growth rate of 0.05 divided by the 15%, 0.15 minus the growth rate, 0.05. That gives us 105 divided by 0.1 should give us 1050 million, right? So that is the whole value of operations. Okay. Number 4, McNally Motor has yet to pay a dividend. However, the company expects to pay a $1 dividend, so D2 is $1. Thereafter, dividend is expected to grow at a constant rate of 5% a year. Beta is 1.4. Risk-free rate is 0.86. Expected market return is 0.12. What's the stock's expected price 4 years from now? So what is P4? Okay, so that's a very interesting question. It has several pieces in it. First of all, instead of telling you the market required rate of return, it gives you the risk-free rate. It gives you the risk-free rate, the market return, and the beta. So with these three, we should be able to calculate the required rate of return, right? Does that make sense? So the K should be really equal to risk-free rate, the 6%. I should really get more careful here. 0.06 plus the expected market return is 0.12. So 0.12 minus 0.06 gives you a market risk premium times 1.4. Okay, so that should give us what, 0.06 times 1.4 plus 0.06 gives us 14.4%, right? So that is K. So once we get K, we can draw out the timeline to look at the whole story. So starting in 2 years from now, so from 0, 1, 2, and 2 years from now, it's starting to give you $1 dividend, right? So, but we want to know what is the price at 4. So this is 3, this is 4. At that time, the growth rate of 5% has been applied for once and twice. So at that time, the dividend of 4, the D4 should be equal to what? $1 times 1 plus 0.05 twice. Right. So that should give us 1.05 squared is 1.1025. So that's D4. Then from D4 we can calculate the P4, right? So we talked about how P4 should be equal to D4 times grow it for another year, the next year's dividend, plus 0.05 divided by the k. Now we have the k, which is 14.4, so 0.144 minus 0.05. And that should give us the final answer. Okay. Right, so the final answer should be equal to 12.315 or 12.32. And that is the correct answer. Okay. So next question, we're talking about probability distribution. So probability distribution is again a weighted average, but it's a slightly different kind of weighted average. So previously we had the beta, right? So previously we had beta for each, and then we want to know what is the beta for whole portfolio. And if we do that, then the beta for the whole portfolio should be portfolio beta is equal to the weighted average of each beta with the capital or the weight of each holding. Okay, so depending on how much money you put in each holding, it's going to be slightly different. But here, when we're talking about probability, we're taking the weighted average with the weight being each one of these probabilities. Okay, so the required return on a market, the required return on the market in this case is becoming a weighted average of all these possible outcomes of the market return. Right, so it becomes the 0.05, the probability times 7 plus 0.3 times 8 plus 0.3 times 9 plus 0.3 here. What did I do? Oh, okay. 3 times, no? Oh, good. Times, where was I? 10 plus 0.05 times 12. Okay, so here I'm not dividing by the sum of all these probability. Remember, we previously, when we have different amount of money invested in different stocks in the portfolio, we need to take each amount and divide by the total amount of the portfolio. But here we're not doing that. That's just because if we have a probability, a set of probability, the set of probability should sum up to be 1 by definition of a probability measure, right? So all the possibilities add up to be, everything is possible. So all probabilities should always add up to be 1. And that's exactly the reason why we have in here, we only need to directly use the probability, don't need to divide the whole thing. Or if you ever want to sum them up, it will be 1 anyway. So this one is going to give you 9.05%. Okay. And what, oh, sorry. I need to do this. Right, so this one is not moving anymore. So then we can use this to calculate the required rate of return. So the stock required rate of return is going to be equal to 6.05 plus the market return 9.05 minus the risk-free rate of 0.05 times the beta, okay, 2.0. That's going to give us what, 12.05%. And what is the correct market price? The market price should be consistent with, if I take that $2 dividend right now here, right, and grow it by 1 year, grow it by 1.07, divided by our required rate of return, which is 0.1205 minus the growth rate of 0.07. That should give us 42.38. Okay, so this is the answer. Okay, so again, there are still some questions. I'm gonna skip it through to look at chapter 9. We only have a few minutes left. Okay, so I'm gonna do this. So I'm gonna go through, say, 1 or 2 questions in chapter 9 and 2 questions in chapter 10. And then, since I'm getting really tired, I'm going to procrastinate a little bit. I'm going to ask you to work through the questions and work it together with the answer that I'm going to post very quickly. And later on, if you have any question, email me and make sure you write on the subject and final exam review question. And then, so you're going to email me, and I'm going to shoot like smaller videos for these specific questions. So I'll post those online. So I don't have to go through every single one of it. So, but anyway, let's pull on. Chapter 9, for a typical firm with a given capital structure, which of the following is correct? All rates are after taxes. So, so a typical firm with a given capital structure, which of the following is correct? One is the departmental, this KD is the departmental return, right? So KS is the stock return, and WACC is the required, it is the cost of capital. So the correct answer is the D1. Okay, why? Because typically the WACC will have a part of it coming from the stock, and a part of it is coming from, a part of it is coming from the debt. I'm sorry, the return. This is the yield of the debt. I'm starting to talk about nonsense. So this is the cost of the stock, and this one is the weighted average capital, right? So since we are taking the average Of course, we're going to have the average in the middle. So somehow in the middle of the higher value and the lower value. And everybody expect the debt to have a lower yield or lower cost compared to the equity. So number 2, which of the following statement is most correct? A, the WACC is a measure of the before tax cost of capital. Is it true? Not really. B, so which part is after tax? We're talking about debt, right? So the debt interest rate is tax deductible, so we have to adjust for that. B, typically the after-tax cost of debt financing exceeds the after-tax cost of equity financing. And that's not true either. Typically the equity is more expensive. C, the WACC measures the marginal after-tax cost of capital. That's true. So we want it to be marginal. We wanted to measure what is the next dollar of borrowing or the next dollar of capital raised. What's the cost of that? And D, statement A and B correct? No. E, statement B and C are correct, and B is not correct. So D, E is incorrect. Okay, so I'm gonna leave it for you. I'm getting, sorry, a little tired. I have a headache. I'm gonna leave it for you to work through the calculations. And I think because last time in the last class we had a pretty good exercise time in the chapter 10, so I'm not too worried about that because you guys did very well in IRR, MPV, and stuff. So I'm gonna leave you right here on your own and I'm gonna post the review answer. Let me see. Review test answer. Right, and that's gonna 9 o'clock. Do you see it? You don't see it. Why not? Good. So it should be posted right now. And do you guys still have any question? The exam is non-cumulative. It's gonna be on chapter 6, 7, 9, and 10. And it will be more emphasis on the calculation question. We'll still have a couple of multiple choice, but still have five big problem solving part. So as you can totally imagine, like each of these chapters will have at least one calculation, right? So any other questions? Okay, if not, I'm going to stop right here. And this is going to be recorded, and so it will start to be showing up on the recording very soon.